Netflix has a new, monstrous story to tell. In 1950s Wisconsin, Ed Gein lived quietly on a decaying farm, hiding a house of horrors so gruesome it would redefine the American nightmare. Driven by isolation, psychosis, and an all-consuming obsession with his mother, he committed crimes that would haunt Hollywood for decades. The third and most harrowing installment of Ryan Murphy and Ian Brennan's anthology series. Watch Monster, the Ed Gein story, October 3rd, only on Netflix.
The views expressed on this podcast are those of the participants, not of Reuters News.
We have a man named Jerome Too Late Powell. You probably heard of him. He's too late. He's way too late. And the economy is so strong that it's pushing through that. Normally it would have been much tougher, but we're doing so well that we're pushing through it. But it makes it very hard for people to get mortgages because too late is too late. Very simple. He's too late.
In his second term, President Donald Trump has pushed Congress into pliancy or irrelevance, drastically reshaped federal agencies, and pushed it to the limits of his legal authority. But he has often gotten pushed back by the courts. There remains one interesting stumbling block to his quest for control of the US government apparatus, and that is the Federal Reserve in the US. Aside from Chairman Jay Powell, the nominally independent central bank's board of governors is split evenly between his own appointees and those of his predecessor. Now the Supreme Court will decide on whether he's able to oust Lisa Cook, cementing a Trumpian majority. But if he's successful, what can he do with a defanged Federal Reserve?
Right. This is enormously important for the Trump presidency, right? Because set aside the merits or otherwise of the attempt to oust current incumbent Fed Governor Lisa Cook, who was appointed by President Joe Biden, and this is ostensibly for mortgage fraud, which she, of course, denies. The Trump administration in general is wildly remaking the U.S. economic rulebook. So they've solidified huge tax cuts. They're doing what is one of the only huge revenue shifts in the modern era of U.S. governance, away from taxes on regular income towards punitive tariffs and kind of using that as a policy tool. They're taking direct stakes in Intel or MP materials and considering all of this other unusual intervention in the corporate economy. And then you just have monetary policy setting off to the side, right? And the Fed's various regulatory functions aside from that. And that's a key part of the remaining puzzle. And so the attempt to grab control of that is our focus this week. It's Jonathan.
And it's Amy, and this is The Views Room, the weekly podcast that dives into the knottiest topics in business, economics, and finance. So, Jonathan, what was it? Too Late Powell. That's what Donald Trump nicknamed Jerome Powell for essentially being too late to cut rates, right? That this is essentially, I think this is what he would want to do, right, with this defanged Federal Reserve, is that you could basically, they would just listen to him like many other of his followers do, and he could basically get them to cut rates, and then everything would be fine in the economy. People could borrow, companies could borrow more, and everything would be great. So what do you think, Jonathan, is the problem with that?
Well, I mean, to be clear, the chairman himself is sort of stuck between conflicting things here. Abstract Trump from this entirely, not the policy mix, because that's key to this. We have an inflationary environment a little bit. There's some stickiness to the inflation data, and there's a big question about whether tariffs, because those are increasing prices throughout the supply chain, right, are going to end up sustaining that. But then on the flip side, you have all this weakness kind of incipient in the labor market. You have this really confusing jumble of economic indicators. So even if he were not under attack from President Donald Trump, Jay Powell would be having a very, very difficult time right now. And then you have half of the Fed Board of Governors who are folks like Stephen Mirren, who is recently appointed, who is outright hostile to central bank independence and has written on this at length before. You have the more mainstream Michelle Bowman and Chris Waller, but everybody in that faction is signaling this more dovish stance that's a lot closer to Trump. And then, of course, you have this broader question, which is, if this were just interest rates, that would be one thing, but the Fed does a lot more, right? It has this really vast authority, from overseeing banks to expanding what is proven since the financial crisis to be an effectively infinite balance sheet to support or steer the financial system. So putting all of this under more expressly political control, especially in an administration like this that likes to punish enemies and tear up norms, we would seem to be looking towards some pretty big consequences here. Fortunately, we've got two great guests with us to talk through all of the ins and outs of this. We've got Peter Tal-Larsen, our editor-in-chief based in London, and Gabriel Rubin, who is our Fed watcher and U.S. economic correspondent down in Washington, D.C. Peter, Gabe, welcome to the Viewsroom. So, right now, Gabe, maybe you can just bring us up to date on what is actually happening with Lisa Cook and why this matters.
Yeah, so Lisa Cook is a Biden appointee, a governor on the Federal Reserve Board. And over the course of this summer, the Trump administration has been waging a campaign against her, ostensibly over alleged mortgage fraud. Now there have been documents that have come out since then that are seemingly a smoking gun suggesting that Lisa Cook did not actually commit mortgage fraud. Reuters reported on some of those documents. But nonetheless, that case works its way through the courts. And the case is essentially, does Donald Trump have the ability to fire Fed governors for cause? Now there's question whether this even is cause, given that, Lisa Cook has not been charged with any crime. There was a referral to the Justice Department from the housing regulator who is very close to the Trump administration, who's very close with Trump. So essentially you have this sort of situation where the Trump administration is testing the waters, testing the courts to see if they can fire a Fed governor. Now, after many, many threats against Jay Powell himself, the chairman, including a just utterly bizarre tour of the Federal Reserve headquarters, which is currently under construction, to see if Trump, the builder, could notice any signs of malfeasance and overspending that would lead him to fire Jay Powell. Anyway, he's trying to fire a Fed governor instead, as a test case to see whether he would be able to fire Powell and accordingly exercise immense control over the Federal Reserve Board if he has the ability to sort of hire and fire willy-nilly, other than just coming up with a nominee who is then confirmed by the Senate and then enjoys independence.
I always think it's worth pointing out that Trump appointed Jerome Powell. So
yes,
there's a lovely irony to this whole situation.
He loves pointing out that it is one of the only mistakes he made in his first term, and he certainly blames the sort of institutionally minded folks who were involved in that first administration, including Treasury Secretary Steven Mnuchin and economic advisor Gary Cohn, formerly of Goldman Sachs. They were sort of seen as sort of keeping the train on the tracks, especially when it came to the Fed, because they were sort of the wise ones in the room who understood the importance of Fed independence. There aren't so many of those voices around anymore.
I sort of wondered about, what you were discussing there, just about, this sort of test case, right? Because Jerome Powell, his term runs out next April, right? So it's not a huge amount of time to wait to replace him. So it is that's what makes this sort of more interesting, isn't it? Because it does makes it look more like a test case, because he could just wait until April.
Yeah, certainly. Trump will, no matter what, get a chance to make his imprint on the Fed. Case in point, he just made an appointment that he didn't even expect to be able to make until January. Stephen Mirren, his close economic aide, is now taking a leave of absence from the White House to serve on the Fed board. And it's only a 4-month term. He's serving in the remainder of a term, but he could then be up for an opening come January. So the point is, Trump will have many opportunities to shape the Fed board, but at the same time, he seems very eager to do so as quickly as possible, especially with the possibility that the economy could go haywire as a result of his tariffs. So I think he wants to get his personnel in power as soon as possible, and not have to depend on the independent-minded Jerome Powell for much longer.
Right. I want to bring in that timing question and the idea of what control of a headline monetary policy would actually do. And Peter, I was wondering if you could step in here. We often, I think, have a pretty simplistic model of the world in our heads where you cut interest rates, that feeds through to the rest of the economy, mortgage rates mechanically come down. residential real estate and commercial real estate investment mechanically go up, and it starts this beautiful flywheel and everybody's doing great. Is that an accurate model of the world? Do we see like this one-to-one, you can kind of cut rates and then you stimulate economic activity? Or would we expect something maybe a little bit different if Trump were to gain control of Fed policy?
Well, I think you put your finger on the key question, which is what we've been scratching our heads about, which is, what is all of this for? What is the end result that they hope to achieve? And the sort of the simple headline approach is to say, well, Trump wants his appointees on the Fed board, and then they will do what he wants and lower interest rates. And Trump thinks that interest rates should be lower. But there's a couple of flaws with that. The first is a mechanical flaw, which is just that even if all of the people that Trump appoints or has appointed and will appoint to the board do what he asks them to, which is not guaranteed. I mean, Powell is a case in point with someone that he appointed who then, proved to be independent. Shock horror. But there are other Fed governors who they're not complete ciphers. So it's not guaranteed that they will act in the way that Trump wants. Then there's the Fed board, and then there is a larger entity called the Federal Open Markets Committee, which is the one that actually votes to set interest rates. And that includes a bunch of other people, including the rotating presidents of the regional Fed organizations. And then there's a whole kind of bureaucratic question about, could the Fed board influence the appointment of those presidents and thereby get control of the FOMC? But anyway, the point about this really is that, first of all, it's not a mechanical certainty that even if Trump can get the people he wants onto the Fed board, that they will then vote for lower interest rates. So that's the first thing. The second thing is then, even if they then vote for lower interest rates, the cost of borrowing in the economy is not solely determined by what the Fed says the short-term interest rate is. The cost of borrowing in the economy is determined actually to a much greater extent by long-term interest rates, as determined by the yield on 10 or 30-year U.S. government bonds. And so, I mean, obviously there is a relationship between these two things, and the Fed is very good at steering things in a certain way and managing expectations and so forth. But if you can imagine those two things kind of completely disconnecting, especially if you had a bunch of hacks on the Fed board who were just taking orders from the president. So, and that seems to be the really big conundrum here is if you undermine the independence of the Fed, you undermine credibility and its ability to control inflation. A logical consequence, you would think, would be that investors in long-dated U.S. government debt would say, hang on a second, I'm no longer sure that this economy is going to be managed for lower inflation. I'm going to demand a higher rate to hold these bonds. So you actually end up with higher interest rates at the long end, higher interest rates throughout the economy as a result of trying to get lower interest rates at the short end.
So could we play devil's advocate, Peter, with this plan? I mean, if you think about it, look to other countries maybe who haven't always had independent central banks. Has this led to a sort of inability to fight inflation, or the kinds of problems that you're talking about in terms of the bond market and borrowing costs, and just this sort of like inability to rely on what they're going to do in the way you would if they were independent?
I mean, so independence is most central bankers would throw up their arms in horror, at least publicly, at this suggestion. But independence is kind of, it's a spectrum, right? I mean, there are degrees of independence or lack of independence, and the Fed has been at various points in that spectrum over the years. I mean, during World War II and in the aftermath of World War II, the Fed was most definitely not independent. It was basically, it existed to facilitate, funding the huge deficit that the U.S. government built up during World War II in the aftermath. So there are degrees of independence, and you can always, and even, you could sort of say in the 1970s, you had Fed chairmen who were more willing to do what the president wanted. So these things go back and forth, and I don't think there's ever such a pure state of independence. But the other thing here is really, the other point I would make is that you can you can have a reasonable debate about where interest rates should be. I mean, quite obviously, this central bank, and like many other central banks in the UK and Europe, got inflation completely wrong in the aftermath of COVID, right? I mean, they came through the COVID cycle and they basically said, okay, well, this is going to be a bit of inflation, but it won't last, and we're just going to ride it out and it will come back down. And that was a huge mistake, and it's undermined their credibility. And so, and there are serious debates to be had about what is the relationship between inflation and other things going on in the economy. What effect is things like tariffs, which we haven't seen in the US at this rate for almost a century. What effect is that going to have on the way that the US economy works? Nobody really knows. We can make an estimated guess, but the consensus is very weak on that. And so there's an entirely reasonable debate to be had about how should these things play out. And actually, interestingly, Stephen Moran, or is it Myron? I don't know. Everybody every time I hear someone talk about him, they pronounce his name differently. But he had an attempt the other day. He made a speech where he had an attempt to basically argue from inside sort of economic theory why the US should have a lower interest rate. And I mean, it was a little bit forced, I think, his argument. He was simultaneously arguing that tariffs would bring in extra revenue for the government, so government borrowing would be lower, so therefore the natural rate of interest would be lower. But Trump's tax cuts would stimulate activity and growth, and therefore borrowing would be lower. So he's sort of having his cake and eating it a little bit. But leave that to one side. I mean, the point is more that I think even within the framework of a sort of accepted economics, you can have a debate about where interest rates should be. The problem is that the way Trump is approaching it seems to be he wants to be able to tell people what to do, and that's the real issue.
Let me grab one end of this. So I'm going to be you're sketching out here a position where you could essentially be a who cares guy about all of this. Like, why should I care about this? The People's Bank of China isn't, it doesn't exercise the degree of independence.
Jonathan, based loosely in monetary thinking.
Based loosely in monetary thinking. There's a lot of, kind of like you say, various arguments to be had about why the current setup hasn't worked. And I want to push on one further, which, Gabe, I'm curious as to what you think about this. If I am a maximalist who cares guy, I can look back at, 4 years ago, we had 2 regional Fed presidents who left over a trading scandal. Ostensibly, they were, as I understand it, kind of on the more hawkish end of the spectrum. There's superficial similarities between then and now. Why do I care now about Lisa Cook versus what was happening back then? And, rolling that into the broader question of is there something even beyond these kind of big, loose, nebulous economic questions, more about kind of the Fed's various powers that should make me care?
Yeah, no. So the situation you bring up from a few years ago is a really good example to sort of contrast with the current one, because the Fed took a very bad situation and I thought handled it pretty well 4 years ago. And this time they are not being allowed to handle their own situation. And the accusations are entirely different. So basically 4 years ago, these 2 regional Fed presidents, Kaplan and Rosengren, they traded securities that were affected by Fed policy. Basically, there was this big review. Powell took it very seriously. He said, our integrity rests on this review. Those 2 Fed presidents resigned ultimately. They took varying degrees of responsibility for it, did not admit any wrongdoing. Certainly, there were no criminal charges or anything like that. But the point is, the Fed resolved that and understood that it was a serious threat to their integrity, a serious threat to their code of ethics, and they dealt with it. And those presidents were out, and they understood that they should be out. In this case, the White House has come up with a seemingly fake issue. If these documents, that'll be determined by the courts, certainly. But so far, courts have said this is not really cause. This is not cause for firing Lisa Cook. So the White House is coming up with its own issue, as opposed to something that was reported by the press and brought up by ethics watchdogs. They are pushing for the firing of a Fed official who they cannot fire, or at least the courts have told them they cannot fire so far. So the contrast between those 2 examples could not be more stark in terms of how you handle a tricky situation with a Fed governor. People make mistakes, people do bad things, people have professional issues, and ultimately they lose their jobs. That's fine. That's the ordinary course of things that happens. This is attempting to sort of seize control of an independent policymaker by using some specious accusations. So I think that, they would the White House would love to compare it to the situation several years ago, make the Fed seem like a den of iniquity that needs to be cleaned up. But really the contrast is very stark between the two situations.
Got it. Okay, so you've defeated my hypothetical indifference to the question of ousting Fed
You
governors.
should care. You should care.
Exactly, I should care. What about my hypothetical indifference to the broader economic question? Because if we are just talking about interest rates and it's unclear whether the Fed is even good at setting interest rates or whether interest rates themselves are this all-powerful, omnipotent tool, is there anything else that the Fed does that I should care about?
Well, I think this is the key thing. I mean, the Fed has many levers that it can pull, and if you think about the sort of the situation that the US is in, it's running large, persistent budget deficits and has a very large and growing national debt situation. So an increase in interest rates is really problematic for the US. If this goes up in long-term interest rates, so it goes up in a sustained way. And then you think about the tools the Fed has at its disposal and the things it could do, just simply going out and buying large amounts of government bonds, for example. I mean, obviously it has done that already in the past in different contexts when interest rates were at the zero lower bound and so forth. But it's not completely unimaginable. And so I guess to sort of take your sort of who cares stance, Jonathan, I mean, you could go to the other end of that and say, well, just think about how things could go really badly wrong. And so, and if you play forward the script and say, okay, Trump gets, let's say the Supreme Court gives him, agrees with him on Lisa Cook. In theory, every Fed governor can be removed for cause. Everybody who's appointed there then serves at the pleasure or displeasure of the president and is under pressure to low interest rates. Investors around the world, many of whom are holders of long-term U.S. government bonds, start saying, okay, this changes the whole situation. We no longer believe that the U.S. is trying to control inflation. We're going to get out of these bonds. And long-term bond yields start going up significantly, 5, 6, 7, 8%, whatever. And you potentially in sort of a debt funding problem for the U.S. So then, the Trump appointees and the Fed board are then lent on to basically say, okay, it's time to start buying government bonds. There's even a name for it. You can dress it up because it's been done in the past by other central banks. You call it yield curve control. And you say, we're not going to try and just control the short end of the interest rate curve. We're also, for the sake of financial stability and the good of the economy, we're going to try and control the long end as well. And we'll basically just buy lots of long dated government bonds to try and manipulate the long-term interest rate. And the Fed balance sheet will expand. Inflation will be problematic because ultimately you're printing money, and sort of and you potentially end up in a really bad economic scenario. So I think this is part of the problem with the Fed is it's this body which has this independent status, which has these awesome powers, and if you put those powers in the wrong hands, they can do really quite dramatic and dramatically bad things.
I was just wondering if you're now an investor, a sane investor looking at this situation, surely you're not waiting for this to happen. Is there anything that you could see, Gabe or Peter, like a premium that's already there for this kind of risk that that basically is, do they defang it, as you say, Peter? Do they sort of take the wheels off and it's just at the whim of Trump to have this central bank with all these powers that he can kind of do what he likes with? Is that already being sort of seen in U.S. treasuries?
Yeah, you are seeing the yield curve steepen. The higher long-term yields, despite short-term yields coming down. And those went up in the wake of Trump's attempts. The yield curve steepened in response to Trump's attempt to fire Lisa Cook, which suggests worries about central bank independence and also expectations about lower shorter term yields. So yeah, no, there's definitely a concern on the part of investors that that is pushing up longer term yields. I mean, if you look at where the 30-year was last September, when there was still a chance that that the Democrat Kamala Harris might win the presidency, it was significantly lower than it, a full point lower than it is right now. So there's definitely consternation on the part of investors about the long-term fiscal status of the U.S., about the long-term independence of the Federal Reserve, and we're seeing that in long-term yields, at least until they start implementing yield curve control to push those down.
I mean, it's still quite limited, though, isn't it, Gabe? I mean,
It is.
I mean, if there seems to be an awful lot of people like Jonathan out there who are like, you know what, it'll be fine.
That's an important caveat. Yeah.
That they may well be right. But I mean, and so I think you can sort of see things. I mean, definitely it comes up when you talk to big overseas investors, sovereign wealth funds and pension funds and stuff that hold a lot of U.S. government paper. You can see it in the gold price. Arguably, sort of that's kind of one of the hedges against sort of inflation. You can see it in the dollar, which is, I think on a 2-year basis has sort of come down quite a long way over the, kind of compared to previous trends. So, I mean, and obviously, like all of this would be clearly if things play out in the way I just described, the sort of the doomsday scenario, clearly the thing that gives there is the dollar. And so that's one thing that people are watching. But, it's not like sort of fixed income investors are running sort of screaming around the trading desks at the moment. There definitely seems to be an assumption, which may yet prove correct, which is that maybe sort of some form of rationality will prevail, and they will decide that that they can't just sort of ignore the bond markets. And actually, the one proof point we have for this is April of this year, in the sort of 2 weeks after Trump did his Independence Day tariff policy. The thing that prompted him to U-turn was basically being persuaded by Treasury Secretary Scott Bessent and one or two others that kind of things were looking really bad in the bond market, and this could have a real knock-on effect for the U.S. Funding itself. And Trump is a leveraged real estate guy who's gone bankrupt, I think 2 or 3 times. So if there's one thing he understands, it's sort of that not being able to borrow is a problem.
Got it. Subtitle this one, How I Learned to Start Worrying and Love Independent Central Banks. Peter, Gabe, thank you so much for joining us on The Views Room.
Good to be here.
Thank you.
Thanks for tuning in. This podcast was produced by Cheryl Pena in New York and Gregory Garner in Toronto. You can listen to a new episode of The Views Room every Thursday on the Reuters app or your favorite platform. And don't forget to tune into our sister podcast, The Big View, every Tuesday, as well as the other great podcasts from the Reuters team. If you like what you heard, please follow The Views Room and let us know what you thought. We have a new email address where you can send us feedback, which is breakingviews-podcasts@tr.com. And check out our views on the biggest stories in business and finance every day on breakingviews.com and reuters.com.